These are global leaders, not just regional leaders. They're, the undisputed number one in what they do.
David Nadel tells us where he is finding undervalued, high-quality growth companies for his Invesco International Small Mid Company Fund. Watch it on Consuelo Mack Wealth Track.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. One of the biggest investment themes of 2025 is how well international stocks have performed on an actual and relative basis compared to the U.S. market. It has been a long time coming. The S&P 500 has outperformed the benchmark international index in 15 of the last 20 years. As we have reported in several episodes of Wealth Track, that has changed this year. Although the S&P has continued to set records, foreign stocks have advanced more rapidly, in some cases twice as fast as the U.S. But there is one aspect of this story that we haven't covered, and that is the status of small and mid-cap foreign stocks with market capitalizations or start market values of $300 million to $10 billion. And that is a specialty of this week's guest. It turns out that foreign SMIDs, as these companies are called, have a lot going for them. First of all, the opportunity set is twice as large. There are around 5,200 companies in the international SMID benchmark versus 2,500 in the U.S. index. Their aggregate market cap is also twice as large, more than $20 trillion versus $8 trillion. They have stronger financials as a group. 90% of international SMID companies are profitable versus 60% in the U.S. universe. Roughly 80% pay a dividend versus approximately 40% of U.S. SMIDs. And the dividends are richer, with 135% higher dividend payout ratios and at recent valuations, 90% higher yields. Plus, they are considerably cheaper with much lower price earnings multiples. Well, this week's guest is David Nadel, lead portfolio manager of the Invesco International Small Mid Company Fund, which he joined in 2019. The fund has a long history. Launched in 1997, it is the longest tenured fund in its Morningstar category, and with nearly $4 billion in assets, is one of the largest. I asked Nadel to explain why investors should consider owning small and mid-cap foreign companies as an asset class. What do they add to a portfolio?
International SMIDs as an asset class are certainly very much overlooked, but they can add quite a bit to a portfolio in terms of risk-adjusted returns and in terms of low correlation. Compared to, let's say, U.S. SMIDs, which is what most people are much more familiar with in the SMID world, the international SMIDs, I think, are quite a bit higher quality, and they're also a lot cheaper. I mean, we all know that U.S. stocks have outperformed international stocks for most of the last 20 years. So there's a huge valuation gap. But what people are less aware of is the quality premium that you're getting with these international SMIDs. So if we're looking at profitability levels, returns on capital, the strength of the balance sheet, lower debt, the generosity of the dividends, the dividend payout ratios or the dividend yields, these are all significantly better with international SMIDs than they are with U.S. SMIDs. And international SMIDs are trading at about half the multiple of U.S. SMIDs. Now, if you look at international SMIDs versus international large, that's also an interesting comparison. Because often when people diversify into international, which it seems like no one is diversified into international at all these days, but when they do it, they typically go to large first because they'll recognize the individual names in a portfolio or they feel more comfort with larger cap companies. The performance history is actually better for international SMIDs. So you're looking at better risk-adjusted returns, much better absolute returns, and you're also looking at lower correlation, because if you think about making a comparison of your international large company with a U.S. large cap company, whether it's Royal Dutch Shell versus Exxon, or it's P&G versus Unilever. These are all multinational organizations that are competing in the exact same markets. International SMID is much more quirky and can be much more local with those businesses. So it stands to reason that you're going to get much lower correlation from international SMID than from international large versus, let's say, the S&P 500, which is, the anchor of a lot of people's portfolios.
Why is it that the quality level of the foreign small to mid-cap companies is so much higher than the quality of the small to mid-cap U.S. companies?
If you think about a $5 billion mid-cap company, if it comes from, Finland or Switzerland, they can't just sell to their home market. They have to figure out how the whole world works. So they have to be very sophisticated, innovative. They have multiple areas of sourcing. These are businesses that are really have the capacity to suffer, and they're built to last. To achieve a $5 billion market cap in the US is, I would say, honestly, a much lower standard. I mean, it is the easiest place in the world to do business. We have 330 million people. 70% of our economy is consumerism. We have one set of national laws and regulations. It's a very pro-business climate. So that's a real contrast to a company achieving a $5 billion market cap in one of these much smaller countries. They are often global leaders because they have had such a tough road to get to where they are. And in their home market, they're viewed as large caps, by the way. A $5 billion company is on the front page, on the Finnish business pages every day, because that's a large cap. So I almost feel like the quality of these businesses that we invest in with their long operating histories, their often global number one positioning, which, by the way, is very rare in US SMIDs to have global number ones, be the undisputed leader. That's something that's really distinct in this asset class.
David, given all of the advantages that you've described of the foreign SMIDs, why do U.S. investors in their portfolios have less than 1% of their allocation to foreign SMID companies?
I think there are a lot of reasons for that. There's the devil you know versus the devil you don't know. Anything abroad always looks more foreign, more distant, therefore less understood, therefore potentially more dangerous. Americans have a pretty severe home country bias when it comes to investing anyway. Other reasons include the dominance of the Batman stocks, or what was the FANG and became the Magnificent Seven, and they're constantly changing the acronym depending on which company is doing well. But it's a serious market concentration in the US. And there's a kind of a natural fascination with those companies that are producing disproportionate levels of S&P earnings and growing faster. And I think people have lost interest in international. I mean, there has been a growth differential. So let's face that fact too. I mean, think about before the global economic crisis, the Eurozone and the US were roughly the same size. The US's economy is now 1.5 times. So it's 50% larger in just the 20 years because there has been better growth. If you add international, which already seems risky, to SMID cap, which seems more risky than large, that's kind of where people become afraid of that asset class. But I think the statistics show that adding it to a portfolio can be really constructive.
Why international now? Why is that more attractive than, and being hopefully recognized as such, than the U.S.?
You also, at some point, you have imbalances that are so severe that maybe reversion to the mean kicks in, right? So,
and these are valuation imbalances.
These are valuation
right?
imbalances,
right.
or even the makeup of the indices. So, for example, the global SMID cap index just 12 years ago was 46% U.S. That's pretty high considering the U.S. is something like 24% of global GDP. But it was 46% of the index. 12 years later, it's 64% of the index, one country. It absolutely dominates. And how sustainable is that? Maybe investors are just going to start to look at international, say, look, I can get a 4% dividend yield instead of a 1.5% dividend yield. I can buy stocks at 14 times earnings instead of an index at nearly 30. And we'll see if some of these other issues, perhaps dollar weakening is another potential catalyst, right? That's been a one-way train for a while. If some of these other issues kick in to kind of refocus investors on where the opportunities are and where they can use their strong dollars to, invest in things that are assets that are much cheaper.
I was intrigued by your comment that many of the small and mid-cap foreign companies are actually global leaders, whereas that would never happen to a small or mid-cap company in the U.S. Can you give us some examples?
Right at the top of the portfolio, we have Carl Zeiss Meditech, and they're the global leader in ophthalmic surgery equipment that's used for eye-related surgeries, also precision surgery equipment. And these, to clarify, these are global leaders, not just regional leaders. They're, the undisputed number one in what they do. Also within the top 10, we have ChemoMetec. ChemoMetec is the global number one pure play in cell counting. So any sort of a biotech process, often cells have to be counted. They make an upfront device, and then there's a consumable element to that business with cassettes that are used in order to go through the cell counting process. We have probably, I'm going to say, a third of the portfolio, a quarter to a third of the portfolio are undisputed global number one companies. Another holding is Cochlear. Cochlear is an Australian company which invented the cochlear implant and has, I think, these days probably about a 60% market share in cochlear implants. So many examples.
You're known as a growth fund. So what else? What are the other qualities that you're looking for?
I would just say we are first and foremost a quality investors. Even before being growth investors, we like to get the growth basically for free. We're willing to pay for the quality because we think that returns on invested capital are the single most important determinant of the investor outcome over, a 3 to 5 year horizon. If you add growth to that equation, you realize value even quicker. But what people really misjudge, unfortunately, is how well you can do as an investor with companies that don't grow that quickly. They maybe grow GDP plus, but they generate value-added internal rates of return year after year. And that is because of compounding. That is the secret sauce in what we do. And that is why, arithmetic means and geometric means are often quite different, and why you will get a better outcome over time with a company that generates a consistently high return on invested capital than a company that vacillates in that return on invested capital.
In an earlier conversation, you mentioned to me that quality has not necessarily been valued well by investors recently, right?
No, I think it's been valued really poorly. Quality has been given very little respect in the market. The good news is that the long-term picture of quality investing is extremely favorable. The bad news is that the year of 2022, when we had this unprecedented 550 basis point increase in rates over the course of 15 months, that was terrible for all long duration assets. And quality stocks fall squarely in the category of long duration assets. So, it has really been a headwind for us to outperform a general benchmark when we're very much a quality focused investor. I do have a lot of faith in quality over the long term, which is why I stay personally invested in the fund, and I think it will do just fine over time. I also think quality is one of the best places to be during periods of uncertainty, tariff uncertainty, geopolitical uncertainty, but definitely the market has been focused on getting paid quickly.
But in the meantime, it is of note that a lot of foreign companies, and again, in this asset class, some of them are family owned, right? Many of them pay dividends. There tend to be very generous dividend payouts and higher yields than you would find in the U.S. small and mid-cap companies.
Yes, that's right, Consuelo.
So you get paid in the
along the way.
While the market, right.
In most markets, more than half of long-term returns come from the dividends. I mean, most talking heads who come onto TV shows are talking only about capital appreciation, and they're, quietly the work is being done for them if they are investing in dividend-yielding stocks. Just about every holding in our portfolio pays a dividend. There is a much stronger culture of dividend paying outside the U.S. than there is in the U.S. It was a big deal for some of the U.S. mega caps to even pay a dividend. We sort of treat dividends as something for, widow and orphan stocks or something. If you can't grow, then you'll pay a dividend. They don't view it that way abroad. Abroad, you have high family ownership. That's often the main source of income for the family is the dividend. The whole culture of trading in your own shares is kind of frowned upon as being a bit unseemly. So they count on the dividend. And they can grow and pay a dividend at the same time. Walk and chew gum. It's okay. We can do both.
If you look at the companies that you're invested in, what are you most excited about? Any companies in particular that you think that we should be aware of?
I think we're quite excited about the IT consulting area. We have a lot of IT consulting companies because this is a kind of agnostic play on the megatrends in tech. We don't, as mid-cap investors, often get a direct shot at themes like AI or even 5G, things that are a little less exciting than AI, or Internet of Things, but we can get the indirect shots at those, and that's often with things like IT consulting. We're excited about, I think, the whole area of value-added distributors, because value-added distributors tend to absorb and pass along inflation at almost immediately, and so we do think we're in a inflationary environment for some time to come. I think for that same reason, we have added some gold exposure to the portfolio, not by owning bullion per se, or even miners, because both of those things make us a little nervous, especially the miners. But companies which serve gold miners with picks and shovels, and one asset management firm that focuses on gold, and then also even a gold retailer in China. The strength of gold is confirmation of investor questioning the future of the dollar and treasuries. I mean, it really goes hand in hand.
That's how you interpret the really phenomenal performance in gold over the last year or two.
Yes, I think gold is a proxy for kind of the chaos meter. There also has been a lot of central bank buying in gold. I mean, there are also technical reasons for the ascendancy of gold. But yes, I mean, gold has been currency for 5,000 years. The dollar's like the dollar's a nanosecond by comparison. But the dollar is the reserve currency. So that's a huge advantage for the U.S. economy. But so those are some of the themes that we're, I think, particularly excited about. I think we're probably more excited about healthcare than most people are. Most people have kind of given up on healthcare, but we think there is, there's a lot of value there. So our top holding, as I mentioned, Carl Zeiss Meditech, is in the healthcare space.
So give me an example in IT consulting.
Towards the top of the portfolio would probably be Nomura Research Institute. So that would be one of the IT consulting companies, or NSD is another one in Japan. These are companies which have long-term relationships with clients, often a lot of them in the financial services area. And they're doing everything from software implementations, all kinds of systems improvements. What we like in general across all businesses, by the way, is highly visible sources of cash flow. And because these companies have long-term relationships with these clients, we get that kind of recurring or repeat cash flow, which is much easier to model out. Of course, that's why you wind up paying a bit more for high-quality companies, is because you can, see the future, or at least see the future with much more certainty than if you're investing in sort of a deep cyclical.
You definitely piqued my interest when you talked about gold exposure in small to mid-cap foreign stocks, and you mentioned a Chinese company?
Yes, Chow Tai Fook is the name of the Chinese company.
And what do they do?
They're a gold retailer. So they're the largest retailer of gold in China. It's a fragmented market, but they're the leader. And a lot of people actually in China are buying gold in the form of jewelry, basically as a store of value. Chow Tai Fook sort of pioneered this notion of buying gold by weight. And so it's not so much the design of the jewelry that people are paying for. They're basically using it more as a store of value. The whole theme of gold, Consuelo, it's often difficult for Americans to kind of like get their arms around. It sometimes it veers into the like conspiracy theory stuff or like late night TV strangeness. You know, if you live in a place like China or India, you don't trust the currency or like other stores of values.
One investment for a long-term diversified portfolio. David Nadel, what would you have us all own some of?
Well, I mentioned that most of my liquid net worth is in my fund, but I'm not going to talk about my fund. But we are very long-term shareholders. And the company I'd like to talk about is VZ Holding. And, I think I may have actually mentioned this company in an episode that we did 7 or 8 years ago. And that's kind of the point.
Yes.
That's kind of the point of being long-term shareholders. So, not much has changed about VZ Holding since we last spoke about it several years ago, but it is triple the value of what it was then.
So independent Swiss wealth manager, is that an appropriate description?
That is a good description. And
okay.
What they're doing, their value proposition is they are providing under one roof all of the key financial services that their target audience would want. Their target audience is 50-year-old plus homeowners. And in Switzerland, those people tend to have a liquid net worth of $2 to $4 million. So there's plenty to work with there. But they're doing the wealth management, the tax and insurance advisory. They're doing succession planning. And because they have this comprehensive approach and they're able to underprice the kind of incumbent big Swiss banks, then anyone would know those names, they're able to retain these customers for, typically until death. So if someone comes to them at age 50, they're going to get 30, 35 years out of that relationship. Plus, typically, those clients add services as they build that relationship with VZ. So the company has an unbroken 25-year track record of profitable growth, growing every single year straight through all of the cataclysms we've lived through in the last 25 years, always highly profitable, and still has, I think, a long runway for growth. They've penetrated about 15% of their market in Switzerland, and they're beginning to expand in Germany and in England. And it's just very much a trusted brand. They do a lot of academic literature that builds them credibility, and they're not, captive within one of those names that everyone, would recognize. And a dividend, of course, along the way. The founder, Matthias Reinhardt, has not sold a share. We think that it's got a bright future.
That's traded on the Zurich Stock Exchange, right? So is
that ADR
right. Or?
No ADR. So that's actually typical of holdings within our fund. We're going to buy the most liquid share when we're investing. That is rarely the ADR. And in fact, the vast majority of our holdings have no ADRs at all. So it's not even as if they have a liquid ADR. So, that's the interesting part about this fund or this asset class. The end user investor in the US rarely knows those companies, as you mentioned, but also rarely has a way to invest directly in those companies. But by investing, they can get access to businesses that many of them are these global number ones that are often competing in areas where US companies don't even compete or don't compete effectively. So there's multiple layers of uniqueness value, I guess is what I'm trying to say, in this whole area.
And that was your career choice to decide to invest in this category, which we're learning so much about, David Nadel. It is very intriguing. So thanks, David Nadel, for joining us on Wealth Track once again. It's been too long.
Yes, it's really been a pleasure to be back, Consuelo. Thank you so much.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week, it is David Nadel's turn. We asked him to share the best investment advice he has ever received. This week's action point is use the power of compounding.
Often the best advice is kind of the simplest advice or maybe the most enduring advice. So when I think back to things I learned from a very early stage in life, one of them was the principle of compounding. And the way I learned it actually was outside of the investing world. It was from singing on TV commercials and eventually on some movie soundtracks. The reason that compounding comes to play is that when you do that as a jingle singer, you're paid for your initial take in the studio, but then each time that jingle airs, there's a check in the mail, or each time the movie streams, there's a check in the mail. And I actually, 45 years later, still get checks for this movie soundtrack I sang on in 1980 called The Verdict with Paul Newman. That principle was really instructive for investing, looking for companies that have recurring income so that you don't have to enter each year starting from zero. You enter each year with maybe 50% or 80% of your income already in the bag, either through long-term contracts or because it's a spares and repairs business model. That is really valuable for compounding, and it really helps the investor experience over time.
One of the simplest methods to compound money is to own dividend-paying stocks through a dividend-focused fund. One of Morningstar's longtime favorites is the gold analyst-rated Vanguard Dividend Appreciation ETF, symbol VIG. Next week, how dramatic changes in global markets have influenced great investor Mark Yockey. It is part 2 of our interview with Artisan International Fund's renowned portfolio manager. Feel free to follow us on Facebook, X, and our YouTube channel. Thank you for spending your precious time with us. Enjoy your weekend and make the week ahead a healthy, profitable, and productive one.